Hello, and welcome to the May Market Update. My name is Brad McMillan. I'm Commonwealth's Chief Investment Officer. April was an interesting month. It wasn't the best of times, it wasn't the worst of times, but there were certainly elements of both. We're going to talk about a couple of things today. We're going to talk about the economy, we're going to talk about the stock market, and we're going to talk about why one is acting differently from the other and what that's going to mean. Let's start with the economy. If you look at the headline data figures, it was a terrible month. At the start of the month, we saw jobs increase by 126,000, which was the lowest we had seen in 2 years and well below what we had gotten accustomed to. At the end of the month, we learned that the economy only grew by 0.2% in the first quarter. Again, well below what was expected. What's going on here? First of all, the employment number, while certainly not good, is absolutely typical for a recovery. In fact, we saw numbers like that about a quarter of the time during the 2000s. So the individual jobs number was nothing to worry about, but it was discouraging. The economy number is also discouraging, but if you remember, we had even worse numbers last year, much worse numbers. And the reason this year is pretty much the same as the reason was last year. We had a terrible winter. It was the coldest winter ever in the Northeast. We also had some other contributing factors. We saw the dollar strengthen significantly, which is good in a lot of respects, but not so much in others. We saw oil prices drop, which is good for the consumer, but bad for business because companies stopped drilling, not entirely, but they cut back considerably, and that hurt the economy. We also had a problem with the West Coast ports, which pretty much disrupted supply chains everywhere in the country. In other words, yes, we had a terrible quarter, but there were a lot of factors in there that contributed to that were actually not long-term factors, because the long-term trends remain very solid. If you look at job growth over the past 12 months, even including the bad March report, we created more jobs in the past 12 months than we did at any point in the 2000s. Consumer confidence moved up, moved down, but it remains at very strong levels. Personal income and personal spending continue to grow, as do wages. Overall, the economy remains in a solid place. In the first quarter, I expect, just like last year, will be a one-off, and we're probably headed into stronger growth going forward. Actually, the stock market reflected that. We had a decent month, with all three of the major U.S. indices rising, and that's despite the fact that at the start of the month, Wall Street expected company earnings to be down almost 5%. That's a big drop. Earnings almost never go down, and there was a lot of worry about what was going to happen. In the event, though, at the end of the month, earnings dropped less than 0.5% at that point. So even though a drop is not good, we're doing much, much better than expected. And this is despite the very weak first quarter and all of the things that we had going on there. The U.S. economy looks pretty solid. The stock market is doing better than expected. The risks out there really are Greece, which again looks like we might be heading into trouble. But even there, although there are problems with Greece, Europe is actually starting to improve. Their economies are starting to grow. So although that remains a risk, it's much less of a risk than it was. Overall, as we close out the month, I see a lot more of the best of times ahead, and I think most of the worst of times is something we've already seen. Even though risks remain, I think this was a pretty good month, and I think chances are spring is coming. Thanks for tuning in, and I'll talk to you next month.